Good. It's 11 o'clock, so we should get going. Thanks very much for tuning in again. I'll be talking to Katie Potts of Herald in a minute, but first we just had a bit of news to have a look at. So I've pulled out three things this week. Let's start with AVI Japan Opportunity, which, as you can see, has been performing reasonably well. And the discount's been quite tight, not as much on the premium as it used to be, but it's been issuing stock, which is good and growing. And small yield, but there we go. The interesting thing about this, I'm really pleased. It's now the best performing Japanese fund over the past year. And actually, if you look at the 5-year numbers, it's also on top there as well. That strategy that it's pursuing is really working. And that's one of the reasons why the discount is tight, I think. And you can see that there are some other strategies here that are not really doing very well. But the reason we're talking about it, so when it launched in October 2018, it had sort of 4-year run, and then they said in October 2022, we will give you the chance to have a liquidity event to possibly take some money out of the fund if you want to. If the strategy isn't working, or if you don't like Japan anymore, then there's an opportunity to cash in. And then we'll do it every 2 years after that. And that was kind of built into prospectus. It's entirely at the director's discretion, and it can be 100% redemption or it can be a partial redemption. That was the way that was kind of worded. And this year, because we the third event, one of these, they're going to be 100% exit opportunity at a 2% discount to NAV. This needs to be approved by shareholders. And whether you actually go for it or not, on the basis of, if you actually did want to sell for whatever reason, despite the amazing performance, there's a sort of real toss-up whether it makes sense or not, given that 2% is not very far off where the discount is now anyway, and obviously markets can move around, so you may as well sort of choose your time to exit if you want to do that. So I don't think it's going to be taken up very much this year. But what they've said is that they're going to now do this every year, and it's all part of this idea that's protecting shareholders from a widening discount. And they think that if they keep the discount narrow, it'll trade at premium more often than it does at the moment, and that will allow them to expand the trust. I'm not convinced of that, to be honest. And I'm also not convinced that an annual redemption opportunity makes sense for this strategy, because it's a long-term approach. It's in small cap stocks. I've talked about it. I'm putting together an article for Citywire. You can read more about it on that next week, I think. Gore Street Energy Storage. I just wanted to mention this. Obviously, it's one of these trusts where the discount has just gone mental. It's still getting wider and wider. The yield's 13%, which just seems incredible. Actually, had somebody talked about the ARC showcase the other day, questioning whether that's sustainable or not. And you'd think that, given what's going with the share price, it wouldn't be. But although the NAV has slipped, it's still above where it was issued at, and I think that's going to reverse and start going up again. What they've just done, and that was just announced today, is that the big battery project that they're building in the Californian energy market, CAISO, is going to be energized in December. We knew that already. But they've signed a contract, what they call a resource adequacy contract, which is a bit like the capacity market, and we have it here in Britain. Basically, what's sort of enshrined in law is that if you are providing power, you've got to be able to prove that you can cover peak demand for that power plus a reserve margin. And so, obviously, if you're running a renewable energy plant, you're going to need to lock in some kind of energy storage contract to go alongside it. So they're not actually going to a contractual arrangement with one of these generators. The counterparty is a Goldman Sachs subsidiary, which is like a sort of energy trading broker. I'm guessing they are standing in the middle and trying to make a market in these. But notice that obviously improves the creditworthiness of the whole thing. And it's decent contract. So it basically covers the entire output of or potential output of the storage project, and it runs for 12 years. And it's $14 million a year from next summer, which is 40% of what they're expecting to earn from this asset. So it's locked in. And it would mean that they could get some debt finance secured on the basis of that now, which would free up some cash for Gore Street, which they could then use to either buy back shares or invest in the portfolio, depending whether what makes sense in terms of returns. So the killer for this is really that they are saying, they wouldn't say this unless they meant it, that they are going to see a fourfold increase in their cash flows from what we had for the year ended 31st of March 2024. Obviously, that doesn't run for FY25. That's going to be from when this contract starts, but nevertheless, that's quite chunky. And the key is it supports the ability to pay that dividend. So that 13% yield may not be that fanciful at all. Actually, I'm quite confident that they will be able to keep doing that. So that would be a big tick in the box. It ought to help the discount narrow, but we'll have to wait and see whether people believe it or not. And then lastly, another trust that's on a big discount that I think shouldn't be is RIT Capital Partners. And you can see it's this familiar pattern where things set off in the wake of interest rate rises, and that's all linked to the growth stock portfolio in the portfolio selling off. But the NAV hit to that was nowhere near as big as the share price hit. That share price has been static for a while now, and I think that discount ought to be closing because they are now talking more and more about getting exits from that portfolio, and we should start to see this come through. There may not be in this current quarter because we've got the US election that's disrupting things, but I can easily see that we get through to Q1 2025 and these things start happening fairly consistently. So I think that discount should be narrowing anyway. But the other thing that's been going on here is that it was kicked off some of the investment platforms, the trading platforms. In July 2023, as Fidelity did it, and it was all around this business with the cost disclosure rules and consumer duty. So optically, it looked as though the charges on this fund were very high because it is subcontracting part of the management to other managers, and it has to include all the fees in this. And in the kit, I think it said the fees were something like 3.8%, which is obviously nonsensical. But nevertheless, that put people off, and Fidelity felt that they had to say to customers, "You can't buy this," which I think was wrong. And I think we said that at the time. We thought it was wrong. But these cost disclosure rules are being sorted out now. They're still not, completely nailed down, but everything is moving in the right direction. So we've got the FCA saying a lot of sort of warm fuzzy words, but they've got to put that down into something concrete. And we've got the government now legislating to bring a new consumer composite investments regime to replace MiFID and PRIPS. And that should mean, if everything keeps going the way it should is at the moment, that investment trusts will not be double counted anymore. We should get sort of a zero in the cost thing, which obviously doesn't mean that there are no costs. We all know there are costs. One of the things we're going to do, I think, today is to draw attention to what Aberdeen has been doing in just explaining how its costs work. They've done a big detailed statements based on what the campaigners sort of recommended people should do. They look really useful, and we hope they're going to be widely adopted. So people will know what the costs are, but we won't get this misleading information anymore. So the good news is that Fidelity's put RIT Capital back on the trading platform. There was apparently a share price reaction to that yesterday. Hopefully this is the start of that discount narrowing. So that's all good news. That's enough from me.